Hi everybody, this is Alan Ellman, the Blue Collar Investor. In February of 2009, I added a new feature to the blog site. At least once a week, I'll be showing you the calculations of a call option that can be sold from one of the stocks either on my watch list or a stock that's been recommended to me by one of our fellow blue collar investors. Today I'm creating this video just to give you an example. This will be actually the first one that I'll put on the website. The stock that I chose today is a company called AeroVironment, and I got it from the IBD 100 list of February 2nd. I'm going to hold the IBD 100 up and block my face just to show you where I got it from. You can see that I circled it, number 8 on the list, AeroVironment. I like this particular stock because, I'll move my hand away here, because of the uptrending price pattern. I ran it through the system and it meets all of our system criteria. I checked the earnings report. The earnings report date is March 2nd, which means that I can't sell the March contract, but now that it's February 2nd, I still have almost 3 weeks left to sell the February contract. So the March contract is out, but possibly the February contract is in. Okay, the February contract expires on the 20th of this month, so we have again just a little under 3 weeks until that contract expires. Now next I checked the technical picture of the stock. And once again I'm going to hold that up, block my face so you can see the chart that I printed out for you. I'm going to hold this up right here, and I'm going to move it around so hopefully you could see most of it. The top of the chart shows the exponential moving averages, and you can see uptrending moving averages with the short term above the long term, and the price bars at or above the 20-day EMA. So that's positive. Underneath that we have the MACD, which is turning negative. You can see the histogram is dropped below 0, although the MACD itself is still above 0. The stochastic oscillator once again dropped below the 80th percentile, indicating a slightly negative propensity in that particular indicator. And all this occurred on average volume. At the bottom of the chart you can see I made notes that we have a mixed technical picture and of course currently an extremely volatile stock market. So when you have a mixed technical picture and the market is volatile, that would lead me to be more likely to sell an in-the-money strike where we have the additional downside protection as opposed to an out-of-the-money strike. But again, that's just me because I tend to be very conservative in my investments. If you're not, you might want to go with the out-of-the-money strike. But again, I lean towards safety rather than risk. So get your pen and pencil out and let's work out these calculations together. Okay, so the February 20th contract for this particular stock, ticker symbol AVAV, is the 35 call is $2.70. Currently, when I'm making this video, the stock is selling for $36.76. So the 35 call is an in-the-money strike price by $1.76. Okay, when we're calculating our ROO, R-O-O, or return on option, we're going to deduct that $1.76 from the 270, because if we are called out, and there's a good chance we will be, we're going to lose $1.76 per share or 176 per contract when that stock is sold. So I don't want to include that as option profit. So we deduct that, and we're going to get a return on our option of 270 minus 176, and we're going to divide that by the bought down value of the stock. We're going to take the $1.76 that we're not including in our option premium or profit. We're going to deduct that from the cost of the stock, the $36.76, and we're going to say that the stock cost us $35. Those of you who have my book or DVDs and such, if this doesn't make 100% sense to you, please review that chapter on calculations. So our actual profit becomes, and here's again the formula, 270 minus 176 divided by 3,500, or the cost of 100 shares of the bought down price of the stock. That comes out to a 3-week profit of 2.7%. Now, to annualize that, since we're doing 3 weeks, we multiply by 17 because there are approximately 17 3-week segments in a year. And then it annualizes to a 46% profit. Now, that's actual profit. If we're called out and we lose money on the sale of the stock, that's already incorporated into that number. So once again, we have a 3-week return of 2.7%, which annualizes to 46%. Now, in addition to that, we also have downside protection because the stock is currently trading at $36.76, and our 2.7% remains intact if that stock drops all the way down to $35. In other words, we have $1.76 downside protection per share, or $176 per contract of protection. So if we divide that by the original cost of the shares, 176 divided by 36.76, our downside protection comes out to 4.8%. So what does this all mean? Well, what this means is we will have a 2.7% 3-week profit as long as our shares do not decrease by more than 4.8% in the next 3 weeks. Is this a good deal? Well, that's for you to decide, but this looks like a deal that I would be very interested in. We have the downside protection and we have a fabulous 3-week return. Okay, so I'm going to be putting up at least one of these on the comments link, not on the body of the article, but on the comments link once or twice a week. I'll try to do it as often as I can, but I'm also in the process of finalizing my second book and answering all of your emails. So count on at least once a week, maybe twice a week, the comments link of the most current articles. Thanks for your attention. I look forward to hearing from you, and good luck to everybody investing in 2009. Take care.